For many financial advisors who believe in indexing, there remains a temptation to try to outperform the core S&P 500, particularly when it comes to avoiding or preventing loss. S&P 500 sectors stand out as tools which could fuel advisor strategies to alter the risk and the return of the parent index. Hello, I'm Sean Wurzbach, leading the S&P Dow Jones Indices Financial Advisor Channel team, and joining me to discuss S&P 500 sectors and a strategy to try to improve upon core are Anu Ganti, she's Director of Index Investment Strategy at S&P Dow Jones Indices, and Sean McCaffrey, he's Managing Director of Swan Defined Risk Solutions at Swan Global Investments. Well, thank you both for joining me today.
Thank you, Sean.
Well, Anu, you publish a monthly U.S. sector dashboard, and actually a number of different dashboards. And I'm wondering if you can start out by highlighting which S&P 500 sectors did the best in 2018, and what did you see, like from the managing risk standpoint, which were the least correlated with the 500?
Sure. So 2018, stepping back, was a roller coaster year. We had trade tensions with China, we had the flattening yield curve, we had uncertainty around the trajectory of future rate hikes, just to name a few.
Right.
And healthcare as a sector was mostly immune to these headwinds and ended up as the top performing sector, followed by utilities and consumer discretionary. On the flip side, we saw that energy was the worst performing sector among the bunch, and this was driven by the weakness in oil prices. And now, turning to your question about correlations, we saw that real estate and utilities had the lowest correlations to the S&P 500, and this is interesting because they performed better during the fourth quarter when there was a more defensive tone in the market.
Yeah, it was nice of them to have that good timing.
Exactly.
So Sean, at Swan Global, you've had a lot of experience working with S&P 500 sectors, and you've brought that into an investment strategy. Can you talk a little bit about that?
Sure. Randy Swan, our founder, created the strategy to produce better long-term returns over full market cycles, primarily by trying to mitigate downside risk. So for that reason, and also Swan's investment philosophy, we don't believe in stock selection or market timing. We think those two are very difficult, and we think asset allocation needs some help. As evidenced in 08 and 09, you know, the common 60-40 portfolio was down, what, 35% during that time frame?
Yeah.
So what we do is we invest all the capital in ETFs and buy a longer dated put, and we try and have that, we seek to have that lose no more than 7 to 10% on an annual basis. And then we sell options on top of that to help try and pay for the long-term hedge.
Yeah. And how are you using the sectors? Because on the other hand, you can just use the 500 instead.
So we started out with just the 500, but we were introduced to the equal weight concept in about 2011. And in 2012, we adopted that because what we found through our own research and some research we read of yours is that the equal weight approach over full market cycles, again, which is what we're committed to, not just chasing the next year's returns, is to provide a better experience over full market cycles, and equal weighting helps improve that.
Right. Well, I think when some advisors think about sector strategies, they are thinking defensive, or they're thinking of this idea of alpha. But I've often heard your leadership talk about how really what you're trying to do is a substitute for core, or over that longer cycle could actually be better than core. So can you put that in perspective? You know, what does Swan mean when they say that the strategy could be better than core?
Well, what we mean by that is if you look at the typical 60-40 portfolio that advisors follow, and if you look historically how our SMA composite has done, we've outperformed that since July 1997, simply because our strategy has better mitigated downside risk than the 60-40 portfolio. We believe going forward it's going to be even more difficult for a 60-40 portfolio to mitigate that, where we are in the current equity cycle, and particularly in the rate cycle, because fixed income just isn't doing what it used to do over the last, bull market for 30 years in fixed income.
Yeah. So Anu, as advisors thought about 2018, I think they thought about it in terms of like two different markets. You had the momentum and tech-driven first part of the market, and then fourth quarter it all reversed. So again, going back to the dashboards, what do you think the dashboard can tell us, or how can the dashboards put that in perspective for us?
Right, and you're exactly right that we saw this dichotomy of two different markets all in the same year. So the first three quarters, factors like momentum and growth outperformed, and these factors have sector exposures to infotech, communication services, consumer discretionary, which
Okay.
you can see on the factor webs on our dashboards.
Yeah.
So these sectors outperformed. Now we turn to the fourth quarter, and suddenly there's a shift, and we went from a risk-on to a risk-off environment. So now defensive factors like low volatility and dividend strategies outperformed, and these factors have sector exposures to utilities and real estate.
Yeah.
So now these sectors outperformed, and the previously outperforming sectors underperformed. So this real radical reversal.
Yeah, and I remember that when we started to enter the fourth quarter and your dashboards came out, your team was warning about concentration risk and you were warning about
Correct.
momentum.
Right.
So yeah, that makes sense how those tools could help you see what's going on. Now, Sean, I think if we were to look at fourth quarter and again how advisors were seeing that reversal, I'm curious, how did that change discussion that advisors were having you, or how did the performance of your strategy help them see ways that they could use the strategy?
Sure, good question. So as you know, our strategy is designed to perform over full market cycles and particularly help to mitigate risk in bear markets. So Q4 we view more as a market correction than a bear market. Having said that though, our equal weight approach helped mitigate the risk greatly to the tune of about 2%.
Okay.
Also, our hedge really started to kick in and protect the portfolio as well. So overall, we outperformed the market in Q4 by about 4%.
Okay. Well, thank you both very much for your insights in terms of sectors and how sectors can help you manage risk.
Thank you.
Thank you, Sean.
If you want to learn more about how indexing works for sectors, please visit us at the link below. You'll find Anu's sector dashboard there, or you can also sign up to receive it and other dashboards delivering free data for a range of market segments and strategies at go.spdgi.com/dashboard signup. Thanks and have a great day.